We live in a world where information is power. The price you pay for stability is often measured by the quality of the intelligence you possess. The question is not whether a crisis is coming. History guarantees that. The question is whether the people who see the crisis coming are telling you about it. In the third quarter of 2025, something unprecedented happened in global financial markets that almost nobody noticed. Chinese billionaires quietly moved $47 billion out of U.S. stocks. Not into Chinese stocks, not into European markets, not into real estate or bonds or cryptocurrencies, but into physical gold. $47 billion worth of metal sitting in vaults across Hong Kong, Singapore, and Switzerland. Now, you might be thinking, so what? Rich people move money around all the time. Portfolio rebalancing, tax strategies, nothing unusual. But here is what should terrify every American investor holding stocks in their 401k. This is the exact same pattern we saw in 2007, right before the housing market collapsed and took the entire financial system with it. The last time Chinese elites fled U.S. assets at this scale, the S&P 500 fell 57% over the next 18 months. Lehman Brothers collapsed. Bear Stearns vanished. Americans lost $8 trillion in wealth. And it all started with Chinese investors quietly selling U.S. assets and moving to gold, just like they are doing right now. Let me show you the evidence, because what is happening is not speculation or conspiracy theory. This is hard data from official sources.
In Q3 2025, that is July, August, September, Chinese investors sold a net $47.2 billion in U.S. equities. That is the largest quarterly sell-off by Chinese nationals since we started tracking this data in 1998. But here's where it gets interesting. That $47 billion did not disappear. It went somewhere very specific. According to the World Gold Council's latest report, Chinese gold purchases in Q3 2025 broke down like this. Individual investors bought $28.3 billion in physical gold bars and coins. Institutional buyers purchased $12.6 billion in gold ETFs and allocated gold. Family offices moved $6.3 billion into private vault storage. Added up, that is $47.2 billion, almost dollar for dollar. They sold American stocks and bought gold. This is not retail investors in Beijing buying a few gold coins for their safe. This is China's wealthiest families, the billionaire class, making coordinated moves. Pony Ma, the founder of Tencent, reduced his U.S. holdings by 40% and bought $2.1 billion in gold. Jack Ma, Alibaba's founder, sold his remaining Amazon and Meta positions and allocated $890 million to gold. Wang Zhanlin of Dalian Wanda liquidated his entire U.S. portfolio and moved $1.7 billion into gold. These are not panicky retail traders. These are some of the most sophisticated investors on the planet. People who have access to information that you and I will never see. And they are running, not walking, out of American stocks and into the oldest safe haven in human history. To understand why this matters, you need to know what Chinese billionaires were doing just 12 months ago. In Q3 2024, Chinese investors were net buyers of U.S. stocks. They added $23 billion to their American equity positions. Now, look at the reversal, from plus $23 billion buying to minus $47 billion selling. That is a $70 billion swing in sentiment in just 12 months. This is unprecedented because Chinese investors have been accumulating U.S. assets for 40 years. Since Deng Xiaoping opened China's economy in 1978, the flow of Chinese capital into America has been almost entirely one direction, inward. Even during crisis periods, the dot-com crash, the 2008 financial crisis, COVID-19, Chinese investors kept buying U.S. assets. They saw American crashes as buying opportunities, but not anymore. Q3 2025 marks the first sustained reversal of this 40-year trend. They are not just reducing exposure, they are exiting entirely and moving to gold. When the smart money that has been buying for 4 decades suddenly reverses course and runs for the exits, that is not a trading opportunity. That is a 5-alarm fire.
Now, let me take you back to 2007, because this has happened before. Exactly once. The U.S. housing market was at its peak. Everyone, banks, homeowners, investors, believed real estate only goes up. Subprime mortgages were being packaged into AAA-rated securities and sold to pension funds. The S&P 500 hit an all-time high of 1565 in October 2007. Everything looked perfect, except for one thing. Chinese investors were quietly selling. According to Treasury Department data, Chinese investors sold a net $31 billion in U.S. equities between Q4 2006 and Q2 2007. At the time, Western financial media barely noticed. Wall Street analysts said it was just portfolio rebalancing and nothing to worry about. But here is what happened next. The timeline is chilling. Q4 2006, Chinese selling begins. $8.2 billion sold. Q1 2007, selling accelerates. $12.5 billion sold. Q2 2007, peak selling. $10.8 billion sold. June 2007, Bear Stearns hedge funds collapse. October 2007, S&P 500 peaks at 1,565. September 2008, Lehman Brothers bankruptcy. March 2009, S&P 500 bottoms at 666, down 57% from peak. From the start of Chinese selling to the bottom of the market crash, 28 months, less than 2.5 years. So here is the question nobody asked in 2007. How did Chinese investors know to sell U.S. assets 12 to 18 months before the crash? The answer is simple. They have access to information that Western retail investors don't. Chinese billionaires have 3 information sources that give them an enormous edge. First, manufacturing data, real-time economic intelligence. China manufactures everything Americans consume. When Walmart, Target, Amazon start cutting orders for Christmas 2007, Chinese factory owners know immediately. They see the slowdown 6 months before it shows up in U.S. retail sales data, 6 months before it appears in GDP reports. Chinese manufacturers saw the slowdown in Q4 2006 and told the billionaires who own those factories. That is real-time economic intelligence. Second, banking intelligence, the shadow audit. Chinese banks are intimately connected to global trade financing. They were on the other side of the trades. While American pension funds were buying subprime CDOs, Chinese banks were quietly reducing their exposure and warning their wealthy clients. They were seeing the quality of the collateral backing the mortgages deteriorate long before the rating agencies admitted it. Third, government intelligence, strategic information. China's government runs one of the most sophisticated intelligence-gathering operations in the world. They monitor capital flows, trade data, satellite imagery of U.S. ports, and credit card transaction data. They knew the U.S. housing bubble was about to burst because their intelligence apparatus saw it in real-time data, not the lagging indicators that U.S. investors rely on. When Chinese billionaires started selling in late 2006, they were not guessing. They knew what was coming. Now look at 2025. Chinese billionaires are selling $47 billion in U.S. equities in Q3. The scale is actually larger than 2007 when adjusted for inflation. $31 billion in 2007 equals roughly $45 billion in 2025. They are selling more now than they did before the worst financial crisis since the Great Depression. If the pattern holds, and history suggests it will, American investors have 12 to 18 months before a major market collapse. That puts us in Q1 to Q3 2026.
So why are they doing this now? What do they see that American investors are missing? Chinese billionaires see a convergence of four systemic risks that threaten the very foundation of dollar-denominated wealth. Risk 1. The AI bubble bursting. Chinese manufacturers are on the front lines of the AI infrastructure buildup. They make the servers, chips, cooling systems, and power supplies, and they're seeing something terrifying. Orders slowing down. According to data from the China Semiconductor Industry Association, in Q3 2025, orders for AI-related chips fell 22% compared to Q2. That is the first quarterly decline since ChatGPT launched in late 2022. Remember, Chinese manufacturers see demand changes 6 to 9 months before they show up in corporate earnings. When NVIDIA, AMD, Microsoft, Amazon cut their chip orders in Q3 2025, Chinese factories feel it immediately. American investors won't see it until Q4 earnings are reported in January 2026. By then, it is too late. Chinese billionaires who own these factories are getting real-time intelligence that AI spending is slowing, not from analyst reports or CNBC, but from their factory managers saying, "We just got order cancellations from 3 hyperscalers." That is why they are selling NVIDIA, Microsoft, Amazon, and Google. They know the AI revenue growth story is about to break. This AI frenzy perfectly mirrors every speculative bubble in history, from the Dutch tulip mania to the 1929 stock crash and the dot-com bubble of 2000. A real technology is wrapped in a trillion-dollar fantasy. The crash comes when reality runs out of believers. Chinese billionaires are simply refusing to be the last believers. Risk 2. The U.S. sovereign debt crisis. Chinese investors are intimately familiar with sovereign debt crises. They have studied the collapse of the Japanese bubble in 1989, the Asian financial crisis in 1997, and the European debt crisis in 2011. And they are seeing these same warning signs in U.S. debt levels right now. U.S. national debt is $35.7 trillion as of November 2025. U.S. GDP is $27.4 trillion. The debt-to-GDP ratio is 130%. For context, Japan's debt crisis hit when debt-to-GDP reached 120%. Greece collapsed at 180%. The U.S. is at 130% and accelerating. Furthermore, the interest payments alone on this debt are now over $1.2 trillion annually. This spending is exceeding defense spending. Chinese investors are looking at this and thinking the U.S. government is on the same path as every debt crisis we have studied. Every great power that thought it could borrow endlessly eventually hit a wall. Rome thought its silver could be debased forever. Spain thought gold from its colonies would flow endlessly. Britain thought global trade would sustain its currency forever. Each was wrong. The lesson is brutal. Debt makes you look rich until the bill comes due. When a nation's obligations grow faster than its capacity to meet them, faith becomes fragile. Chinese billionaires need to exit before the dollar collapses. Risk 3. Asset seizure risk and sanctions immunity. There is an uncomfortable truth that nobody in American media wants to discuss. Chinese billionaires are preparing for the possibility of U.S. asset seizures. Since 2022, the U.S. has frozen $300 billion in Russian assets, threatened to confiscate them entirely, banned TikTok, which is Chinese-owned, sanctioned Chinese tech companies, and restricted Chinese investment in U.S. sectors. Chinese billionaires are watching this and thinking, if the U.S. can freeze Russian oligarchs' assets overnight, they can do the same to us. The confiscation and restriction of foreign currency reserves following the 2022 invasion of Ukraine demonstrated how rapidly access to foreign currency reserves could be restricted through international sanctions. This event acted as a catalyst for China and other nations to build resilience against dollar leverage, which has been explicitly weaponized. So, if you are a Chinese billionaire with $5 billion in U.S. stocks, bonds, and real estate, and you see the U.S. government increasingly willing to use financial assets as weapons, what do? You move your wealth to something the U.S. government cannot seize: physical gold in Singapore, Hong Kong, or Switzerland. Gold is viewed as the deep-time asset that carries zero counterparty risk and zero Treasury's opinion of you premium. This is not just wealth preservation. It is a geopolitical mandate for sanctions immunity. Risk 4. The dollar decline as reserve status falls. Chinese investors are also watching the dollar lose its reserve currency status in real time. Since 2020, the dollar's share of global reserve currencies has fallen from 62% to 58%. That might not sound like much, but it represents trillions of dollars flowing out of dollar-denominated assets. Where is it going? Gold, up $2.3 trillion in central bank reserves from 2020 to 2025. Yuan, up $890 billion. Euros up $450 billion. The BRICS nations are actively working to create an alternative to the dollar for international trade. China is leading this effort, and Chinese billionaires are front-running it by moving to gold now before the rest of the world realizes the dollar's dominance is ending. The lesson is clear. The US dollar's dominance allows America to export inflation abroad. But when that dominance fades, inflation comes home. They are preparing for the inevitable devaluation of the dollar.
The choice of gold is not random. It serves a very specific purpose in crisis scenarios. It is the perfect hedge against the 4 systemic risks identified. 1. No counterparty risk. When you own a share of Apple, you are dependent on Apple's management, the U.S. economy, the dollar, and the stock market staying functional. If any of those break, your Apple shares could become worthless. When you own physical gold, you depend on nothing. It is pure metal. It has value because humans have assigned it value for 5,000 years. No CEO can mismanage it. No government can print more of it. No stock market crash can erase it. This elimination of counterparty risk is vital when sovereign bond markets face a growing crisis warning for 2026. 2. Global acceptance and seizure immunity. Chinese billionaires are moving to gold because they can take it anywhere. Physical gold stored in Singapore cannot be seized by the U.S. government in a geopolitical conflict. It is portable, liquid, and accepted everywhere on Earth. The wealthy are rushing to store gold in neutral jurisdictions like Singapore because they recognize the need to minimize geopolitical risks and tariffs. Furthermore, they are strategically shifting away from derivative or paper-backed instruments toward allocated physical metal, prioritizing the elimination of credit risk. 3. Inflation hedge and purchasing power preservation. Gold is the only asset that has preserved purchasing power across every major currency collapse in history. Weimar Germany, 1923, gold holders maintained wealth. Zimbabwe, 2008, gold holders survived. Venezuela, 2016 to 2020, gold holders escaped. When money dies, gold survives. The current U.S. debt and deficit spending necessitate future devaluation. The government's hidden tax, financial repression, systematically erodes the purchasing power of cash by maintaining interest rates below inflation. This subtle theft is why the wealthy seek tangible assets. Gold protects against this slow, quiet theft. Gold's historical performance during previous crisis periods is remarkably consistent.
2008 financial crisis. Gold was largely flat during the collapse. March 2008, $920 per ounce, to March 2009, $920 per ounce. But by September 2011, gold had risen to $1,895, up 106%, while the S&P 500 took 4 years to recover its 57% loss. Gold holders preserved capital and then made money. 2020, COVID crash. Gold rose 2.5% while stocks fell 35%. By August 2020, gold hit $2,075, up 31% in 8 months. Again, gold protected wealth during the crash and rallied while stocks were still recovering. The gold price forecast 2026. If the pattern holds, we should expect gold to reach $3,200 to $3,500 per ounce at the bottom of the crash in Q3 2026, up 25 to 35% from current $2,650, and then rally to $4,000 to $4,500 during the recovery phase, up 50 to 70%. Goldman Sachs, recognizing the structural demand, forecasts the price to rise to $4,000 per troy ounce by mid-2026. This bullish environment is further reinforced by central bank buying. In Q3 2025, central banks worldwide purchased 337 tons of gold, the highest quarterly demand since 2022. China's central bank alone added 78 tons. They are diversifying away from dollar reserves and into gold. This creates a structural bid under the gold price that did not exist in previous cycles. Supply is flat, while demand from central banks and billionaires is exploding. Basic economics dictates price must go up. Gold versus Bitcoin. While Bitcoin has seen a rapid ascent, it still carries unique systemic and technical risks, such as the threat of quantum computing, that gold, a physical asset, does not face. Gold has reasserted itself as the preferred, non-technical crisis hedge for institutional wealth, due to its more stable role in times of crisis and elimination of counterparty risk across all dimensions.
Most investors lose everything because they do not understand the mechanics of collapse. Financial history shows that collapse does not happen all at once. It happens in 3 distinct waves. Wave 1, the smart money, now through Q1 2026. This is the phase we are in now. Billionaires, sovereign wealth funds, and family offices are quietly selling U.S. stocks and buying gold. The scale is between $50 billion to $100 billion. They are selling into strength to avoid crashing the market. They are exiting positions slowly to avoid tipping off the market. Selling $47 billion over 3 months puts gentle downward pressure on valuations. It does not crash anything. This is the time when the informed, like Warren Buffett, sitting on $334 billion in cash, and Michael Burry, holding $1.1 billion in put options, position themselves. Wave 2, the institutions, Q2 to Q3 2026. This is when the crash begins. Hedge funds, pension funds, and mutual funds are forced into selling. The scale is massive, $500 billion to $1 trillion. This forced selling is what creates the crash. As retail investors start noticing stocks falling, they redeem mutual fund shares. Funds must sell stocks to raise cash, creating more losses and more redemptions. A death spiral. This is exactly what happened in 2008. This is when gold really takes off because institutions rotate to safety. Wave 3, the retail panic, Q4 2026 to Q1 2027. This is the saddest wave, the retail capitulation bottom. Retail investors and 401k holders panic sell at the bottom. The scale is $2 to $3 trillion. By the time retail investors realize what is happening and sell everything, the bottom is already in. They sell stocks at the absolute low and buy gold at a price that has already rallied significantly. This is the maximum pain experience, buying high and selling low. If you act now, during Wave 1, you can sell stocks at current prices before the crash, buy gold at $2,650 before it runs to $3,500 plus, avoid the institutional panic of Wave 2, and avoid the retail capitulation of Wave 3. If you wait until Wave 2 or Wave 3,
You will be the one selling stocks low and buying gold high. The window to position yourself intelligently is closing.
The actions of Chinese billionaires are not just a market signal. They are confirmation of deeper structural failures we have tracked across centuries. The debt engine and financial repression. The entire global financial system is built on an inescapable debt architecture. The fact that global debt stands at $315 trillion, 3 times the size of the global economy, is a paradox. If everyone owes money, the world effectively owes money to itself. This debt is not a temporary problem. It is the system working exactly as designed. The U.S. government, facing unpayable debt, utilizes financial repression. This is the silent subtraction of value, achieved by keeping nominal interest rates below the rate of inflation. This invisible system is designed to transfer wealth without you ever noticing. It feels like bad luck, but it is policy. The middle class bears the brunt, watching their savings erode while asset prices at the top inflate. Governments mock gold as a relic and dismiss Bitcoin as speculation to discourage citizens from leaving the system they control. This ensures compliance. This mechanism has historical roots. Roman emperors debased the silver denarius with copper to fund wars. In ancient Egypt, kings recalled coins to reissue them with less precious metal, pocketing the difference, a hidden tax. Today, it is done with trillions of digital dollars created out of thin air. The dollar's dominance, or exorbitant privilege, allows the U.S. to export inflation abroad. But when that dominance fades, as Chinese billionaires are predicting, inflation comes home with catastrophic force. The pyramid logic of finance. Modern finance operates on the same logic as a pyramid scheme. Stock valuations are driven by the expectation that someone else will buy higher tomorrow. The entire system depends on constant exponential growth. When the system contracts, the system rewards those closest to the money source, the Cantillon effect. When a collapse occurs, the real pyramid master shows up, the central bank. They intervene to save the system, not the citizens. In 2008, the central bank printed trillions to save the housing pyramid. The consequences were transferred to the late participants, the middle class and savers, through asset inflation and financial repression. The Chinese billionaires are recognizing that the liquidity required to sustain the current AI tech bubble is failing. They see the signs cited by history, prices rising faster than comprehension, and the persistent narrative that this time is different. They are moving to gold because they know that bubbles die when reality runs out of believers. The warning from previous collapses. The pattern of wealth transfer during crisis is centuries old. 1929, Jesse Livermore saw the crash coming, bet against the market, and made $100 million. While ordinary families lost life savings, billionaires like Rockefeller and Morgan used the chaos to buy companies and land for pennies on the dollar, consolidating control. 1933 gold confiscation. FDR's Executive Order 6102 made private gold ownership illegal, allowing the government to revalue gold from $20.67 an ounce to $35 an ounce. This instantly created a 69% windfall for the state, funded the New Deal, and forced a wealth transfer from citizens to the government. This action set the precedent that, in a crisis, private property is secondary to collective survival. 2008, Chinese investors quietly exited before the collapse, avoiding the 57% drawdown. The current action by Chinese elites is the latest iteration of this timeless pattern. They are positioned to become the billionaires who profit from the next Great Depression.
If you recognize that Chinese billionaires are right about the Q2-Q3 2026 crash warning, you must act now, during Wave 1. Knowledge without action is worthless. 1. Assess your exposure and reduce equities. Calculate your exposure to U.S. stocks, including 401k allocations and index funds, S&P 500, NASDAQ. If you are more than 50% in U.S. equities right now, you are overexposed. Chinese billionaires are going from 60% U.S. stocks to zero. You do not have to go to zero, but you should reduce exposure to 30 to 40% maximum. Specifically, reduce or eliminate overvalued tech stocks like Nvidia, a PE of 60, and Palantir, a PE of 300. These are the stocks China's billionaires are dumping because the AI revenue story is breaking. 2. Build a gold position, 15% to 25% target. Gold is the crisis hedge. Target an allocation of 15 to 25% of your portfolio in gold. 1. Physical gold. Buy bars or coins from reputable dealers. Pros: no counterparty risk. Cannot be hacked or frozen. You physically own it. Cons: storage and security challenges. Recommended allocation: 10 to 15% of your portfolio in physical gold if you can safely store it. The ultra-rich are already storing their metal in Singapore. 2. Gold ETFs. Examples include GLD or IAU. Pros: easy to buy and sell, secure storage. Cons: counterparty risk since you do not own the physical metal directly. Recommended allocation: 10 to 20% to gold ETFs, especially for retirement accounts. 3. Gold mining stocks. Examples: Newmont, Barrick Gold. Pros: leverage to gold price, can outperform gold itself. Cons: company-specific risk, more volatile. Recommended allocation: 3 to 5% as a speculative position, not a core safe haven. A $100,000 portfolio should allocate $20,000 to gold, $12,000 in physical gold bars, $6,000 in ETFs, and $2,000 in gold mining stocks. 3. Increase cash and preserve buying power. Target 20 to 30% cash. This cash serves two purposes: safety during the crash so you can sleep at night, and buying power at the bottom when stocks are 40 to 50% cheaper. Chinese billionaires are reducing stocks and going to cash and gold. Cash provides the liquidity needed to buy quality assets when others are panic selling. The recommended defensive portfolio, 2026 outlook. For the next 2 to 3 years, a defensive portfolio should look like this. 1. Quality stocks, Microsoft, Google, defensives, 30%. 2. Gold, physical plus ETFs, 25%. 3. Cash, dry powder, 25%. 4. Bonds, short-term, safety, 15%. 5. Gold miners, speculative upside, 5%. This portfolio survives the crash, protects capital, and positions you to buy the bottom. The final warning: you have 3 to 6 months to reposition, not 3 to 6 years. By Q2 2026, it will be too late. The crash will have started. Stocks will be falling. Gold will have already rallied 20 to 30%. You will be selling low and buying high if you wait then. The pattern is always the same. Brilliant investors recognize unsustainable conditions, get ignored by the crowd, and get proven right when reality reasserts itself. The Chinese billionaires were right in 2007. They are not wrong now. The only question that matters is, will you listen this time? If you want financial freedom, stop chasing the next mania. Learn to recognize the pattern. Because when the smart money runs for the exits, you should too.